The closing bell rang exactly 15 minutes ago on this Thursday, July 9, 2026, and we are skipping the fluff and getting straight to the scoreboard.
Because you really need to look at what's under the hood today.
Right. I mean, the screens across the trading floor are flashing bright green, but you have to wonder if it's a mansion built on sand. Look at these final numbers. The S&P 500 closed up 0.81% to 7,543.64.
And you had the NASDAQ surging up 1.30% to finish at 26,406.89.
Exactly. The Russell 2000 climbed 1.22%, and the Dow was sort of the laggard, but, still added 0.27% to end at 52,487.41.
Yeah, so on paper, you're looking at what appears to be a textbook key reversal. It completely shook off yesterday's geopolitical panic.
But the real risk here is that this whole tape is a lie.
It is. Underneath that surface level green, the internals are flashing just extreme institutional hesitation.
So that's our mission for this deep dive. We're tearing through a massive stack of institutional strategy notes, the closing prints, the volatility data, all to figure out the narrative.
Right. Is this a genuine high-conviction breakout, or is it just a structural head fake designed to trap retail money?
And to figure that out, you really have to look at what the real money is doing into the close. Which brings us to the most glaring red flag right off the bat, the volume confirmation, or the lack of it.
The total lack of it. Trading volume is the foundation of any move.
Right. If you build a 3-story mansion, you want it resting on poured concrete, which in our world is long-term asset manager capital.
But today, the NASDAQ basically built a massive rally on loose sand. I mean, NASDAQ 100 volumes were down more than 20% compared to their 30-day average.
Wow. Down 20% on a day where it surges over 1%.
Exactly. And broader ETF volume was stuck around 80 to 82% of its normal rate.
Which explains why the floor activity scored a completely dismal 4 out of 10 today.
Yeah, the large asset managers, the sovereign wealth funds, the pensions, the real money, they basically sat out today's session entirely. They did not initiate new long positions.
But wait, if the real money sat out, someone still had to hit the offer to drive the NASDAQ up 1.3%. I mean, the indices don't just magically float up on their own.
The fast money hedge funds.
Ugh.
They were operating in a total liquidity void. I mean, we are dealing with thin summer vacation liquidity right now.
So algorithmic trading desks can just push the index around.
Totally. They can push it a mile wide, but the buying power is only an inch deep. They just selectively deployed capital into beaten-down tech to play a short-term swing.
So the gains were just fueled by a lack of overhead selling pressure in the morning?
Exactly, rather than, robust organic institutional accumulation.
Which makes the final minute of the session so incredibly critical. We have to talk about the closing print.
Because this is where the facade really just crumbles.
Yeah. The market finished heavily tilted for sale. 210 basis points for sale.
Which is massive.
It's massive. For context, the normal 30-day average is 38 basis points of a net buy imbalance. So at 3:59 p.m., an absolute avalanche of sell orders hit the tape. Why are institutions waiting for the absolute last second to dump risk into the passive closing flow?
Because of the mechanics of the market on close order. I mean, active managers know that passive index funds are structurally required to execute at the closing bell.
Just to match their benchmarks, right?
Exactly. So if a large institution wants to offload massive risk without tanking the price and ruining their own intraday execution, they hide their footprint in that closing cross.
Oh, that makes sense. They use the intraday strength generated by the algos to trim their exposure.
They aggressively faded the rally because the underlying macro picture remains incredibly unstable. Holding long exposure overnight right now is just a really dangerous game.
And the primary catalyst for that instability is straight off the geopolitical tape.
The Middle East.
Right. During regular cash trading hours today, the narrative was that the market had brushed off yesterday's U.S.-Iran military exchanges in the Strait of Hormuz.
Yeah, it looked like they totally ignored it.
Because we saw Brent crude slump 2.2% to $76.30.
Yeah.
WTI settled lower at $72.10.
Yeah. And because energy was bleeding out, that allowed the 10-year Treasury yield to drop 2 basis points.
Down to 4.547%, yeah. So the algorithmic models just priced in a localized conflict.
They assumed an imminent ceasefire. But here's the catch-all. Those algorithmic models don't read the news after the cash market closes.
Right, the after-hours tape bomb.
The minute the bell rang, liquidity vanished and fresh headlines dropped. There were fresh military strikes exchanged between the U.S. and Iran in the after-hours session,
And crude immediately caught a massive bid. It reversed hard back upward.
which creates terrifying gap risks.
So if I'm a regular session trader and I shorted energy today or, went heavy long on equities based on those ceasefire hopes, what does tomorrow morning look like for me?
It looks like an immediate margin call.
Ouch.
Seriously, traders who faded that geopolitical risk during the cash session are now trapped in a severe after-hours squeeze.
Because when the cash markets open tomorrow, they can't slowly unwind.
No, they have to hit the panic button simultaneously. The institutional notes we're reading explicitly warn to expect energy stocks to aggressively gap up on Friday.
The broader market got caught totally offsides on this. So energy is a structural wild card right now.
Absolutely.
But if we pivot to equities, there is this massive polarizing divergence in capital flows.
The SIPs versus CHIPS divergence.
Yeah. Old economy, consumer defensive names versus new economy tech. And the catalyst for the SIP side today was PepsiCo kicking off Q2 earnings.
Which is a perfect window into the reality of the American consumer right now. I mean, Pepsi stock fell 3.54%, dropping to $137.46.
Which is fascinating because they actually delivered a marginal top-line revenue beat. The headline numbers were totally fine.
But the stock tanked the second the earnings call started.
Right, because they warned of a severe North American consumer slowdown. They cited completely flat volumes and faltering snack sales.
And the specific mechanism they pointed to, high prices at the gas pump, it's destroying discretionary spending at the convenience store.
Because the moment a consumer spends an extra $20 filling their tank.
That $5 bag of chips is the first thing cut from the budget.
Exactly. And that micro-level data immediately triggered a macro-level sector rotation. Yeah. Capital just systematically rotated out of defensive heavyweights like Pepsi and Costco.
Which dragged the broader consumer staples sector down 1.4%.
But wait, I need to push back on this idea that capital is just fleeing the market entirely, because I'm looking at the breadth metrics right now.
Okay, what do you see?
The advanced decline ratio was a very healthy 1.75 today. Small caps in the Russell 2000 rallied over 1%, keeping exact pace with the NASDAQ. We had 61.6% of all traded U.S. equities finishing in positive territory.
Right.
So that flies directly in the face of your hollow market theory. I mean, how do you square broad participation with a lack of institutional buying?
Because it's an absolute zero-sum game today. The long-only funds aren't calling up their prime brokers and injecting fresh cash from the sideline.
So where's the money coming from?
It was a textbook funding rotation. Look at the Dow Jones Industrial Average. It languished all day, closing up a mere 0.27%.
Right.
Portfolio managers didn't bring new capital to the table. Instead, they actively liquidated those defensive, old economy value names in the Dow.
Oh, to generate the cash required to chase the tech rally.
Exactly, to fund a massive high beta buying spree in growth and semiconductors.
And the magnitude of that semiconductor buying spree cannot be overstated. We're strictly focusing on the mega caps driving the structural tape here.
Because Broadcom was the big story today.
Yeah, Broadcom, AVGO, closed up 4.69% after dropping two massive pieces of news.
Huge news.
They officially extended their custom chip agreement with Apple through 2031, which is a deal expected to exceed $30 billion.
And they guided next quarter AI chip revenue to $16 billion.
Plus, you had Meta jumping 4.0% after announcing they're targeting self-production of their custom Meta compute chip by September.
But that Broadcom deal is the one you really need to pay attention to because it fundamentally alters their economic moat.
Because they aren't just selling standard parts anymore.
Right. When you supply standard off-the-shelf silicon, you're just a vendor. You can be replaced if a competitor undercuts your price.
But a custom silicon agreement through 2031.
That means Broadcom is heavily integrated into Apple's core R&D pipeline. It completely kills the design-out overhang that has plagued Broadcom's stock for months.
Right, considering Apple represents roughly 20% of their revenue.
Yeah.
So they transition from a replaceable vendor to a permanent structural partner.
Exactly. And this tech rally wasn't just a localized U.S. event today. International capital flows directly dictated the U.S. semiconductor tape.
You're talking about the Kospi.
Yes. Look at South Korea's Kospi index. On Wednesday, the Kospi suffered a catastrophic 5.4% bloodbath.
But today, it staged a massive intraday U-turn. It opened deep in the red and closed green.
Driven almost entirely by SK Hynix. The memory chip titan surged 5.3% after news broke that its upcoming U.S. ADR offering is more than 7 times oversubscribed.
7 times. Wow. That proves there is just an absolute international veracity for memory chips.
Yeah, and when global funds can't get enough allocation in the Hynix ADR, They look for domestic proxies,
Right, that capital immediately spilled over into the U.S. market, creating a massive tailwind for domestic players like Micron,
which jumped 5.2% on the session.
heavily citing surging AI memory demand at their central New York mega site. But, okay, this brings up the ultimate day two problem for me.
The volatility mismatch.
Yeah. If semiconductors are rocketing higher on structural deals and the major indices are flashing green, you'd assume the risk is off the table. I'm looking at the CBOE Volatility Index, the VIX.
The classic fear gauge.
Right, it dropped 6% today, slipping back below 16. On the surface, it's practically screaming at you to relax. But these strategy notes are emphasizing extreme historic institutional stress.
Which seems like a paradox.
Totally. How do we reconcile a VIX at 15-something with a market that you're telling me is on the brink?
Because this is the most vital structural insight of the entire day. The VIX is a flawed metric for this specific market.
Because it only measures implied volatility for the S&P 500.
Exactly. It's a broad average. Yes, it's sitting at a calm 16, largely because the rotation into slower-moving defensive and value sectors suppresses the aggregate volatility of those 500 stocks.
So what should we be looking at?
You need to look at the VXN. It specifically measures volatility for the NASDAQ 100. And the VXN is currently sitting at a highly stressed 28.
Wait, so if S&P volatility is 16 and the NASDAQ is 28, if we run the math on that spread...
It puts the VXN to VIX ratio at 1.7.
1.7? That's not a minor divergence?
No. It is the highest level in 23 years.
Stop right there. 23 years. That means this divergence is currently surpassing the absolute peak of the 2008 financial crisis.
It is. In 2008, the ratio peaked at 1.6. Today, we are at 1.7.
That's unbelievable.
To put it in dollar terms, S&P 500 volatility is currently 43% cheaper than NASDAQ volatility. The VXN has now traded above 20 for 5 consecutive months.
Which is the longest stretch of elevated tech volatility since the 2022 bear market. But explain the mechanism behind that options pricing. Why are market makers demanding such a massive premium for NASDAQ volatility compared to the S&P?
Well, because options pricing is ultimately a measure of expected distribution. Tech desks are aggressively buying downside put protection on the NASDAQ.
Because they know the foundation of this rally is entirely fast money algorithms.
Exactly. They know it can vanish overnight. And market makers, the dealers who have to sell those puts, they understand the exact same tail risk.
So they drastically jack up the premiums to compensate for the danger of a sudden tech collapse.
Right. S&P index options traders are showing pure complacency, but tech desks are paying astronomically high insurance premiums just to survive the week.
It's the ultimate illusion. I mean, the broad market looks like a calm, glassy lake, but underneath, the tech sector has violent, earthquake-level undercurrents.
So if you are blindly buying the NASDAQ because the VIX is falling, you are walking right into a trap.
All right, so let's translate that structural dynamic into tomorrow's open. How should you actually navigate this tape?
We need a practical day two playbook based on the options data.
Yeah, because the institutional discs are hyper-focused on this Gamma Flip point at 7,505.40 on the S&P.
That's the magic number.
Walk us through the mechanics of a positive gamma regime and why that specific 7,505 level dictates how the market breathes tomorrow.
Okay, so this comes down to delta hedging. Market makers or options dealers act like bookies. They do not want to bet on the direction of the market.
They just want to collect the spread and the fees.
Exactly. So when the S&P 500 closed at 7,543 today, it successfully climbed back above that 7,505.40 gamma flip point.
Transitioning the market out of negative gamma.
Right, out of a volatile negative gamma regime and back into a dealer-supported positive gamma zone.
And how does positive gamma force dealers to act?
Well, in positive gamma territory, as the market goes up, dealers mathematically find themselves holding too much long exposure.
Okay.
So to flatten their books and stay neutral, they are structurally forced to sell stock into the rally.
And conversely, if the market dips,
their models force them to buy stock to balance out, so they are systematically buying bips and selling rallies.
which forcibly dampens volatility.
Yes. It suppresses runaway trend extensions, but it creates exceptionally reliable sticky floors and ceilings for active traders to operate within.
So let's map out those exact sticky floors and ceilings. Based on the institutional flow, the immediate support pivot sits right at 7,500.
Correct. There is massive option open interest converging at 7,500, acting as a structural magnet for those dealers.
But the real danger level, what the quantitative notes call the trap door, the put wall, is sitting down at 7,470 to 7,475.
Yeah, and if geopolitical news out of the Middle East flares up overnight and gaps the market below 7,470 tomorrow morning, we flip back into negative gamma.
And then dealers selling aggressively cascades to hedge their short put exposure, and the floor falls out.
It would get ugly fast.
And on the upside, where do they step in to cap the rally?
The ceiling, or the call wall, is sitting heavily right above us at 7,550. Expect strong seller supply and dealer short call hedging to completely stall any momentum near that exact level.
So bringing this all into a high-conviction macro strategy, do not expect a breakout trend day 2 tomorrow. Standard retail traders see today's green close, they see Broadcom's $30 billion deal, and they expect tomorrow to immediately rip higher at the bell.
But the options math gives the continuation breakout only a 30% probability. Because we are trapped in positive gamma, back-to-back trend days are statistically rare.
So it's just going to be range-bound chop.
Exactly. The institutional playbook dictates tomorrow will be a chop session. The highest probability move is not to chase a breakout.
It's to look for a tactical mean reversion long on a morning dip.
Yes, into that 7,500 to 7,505 zone with a tight stop directly below it. You ride the mechanical, dealer-driven bounce back toward the 7,550 ceiling.
You fade the extremes. You do not chase the middle of the range.
Exactly.
And if you're looking for specific high-conviction stock setups inside that chop, the notes highlight 2 major day 2 plays. First up is Broadcom.
AVGO, yeah.
With that Apple extension structurally altering their moat and killing the design-out overhang, institutional money is going to look for an entry. The playbook here is to wait for a morning consolidation backtest of the $385 breakout level.
Right. If dealers defend $385, you go long, targeting a run to the $400 psychological level.
Love that setup. The second day 2 play is Micron. It was heavily beaten down, dropping nearly 17.8% over the prior week before today's 5.2% rebound.
Yeah, Micron is currently transitioning from a deep oversold condition back into its core uptrend.
And with the SK Hynix ADR listing acting as a sector-wide bid, Micron is perfectly positioned for a major short squeeze continuation.
You want to watch for a clean break above Thursday's intraday high. That will force early short sellers to cover, triggering a fast gap fill to the upside.
So to recap the institutional reality of today's session, what looked like a massive broad market tech victory on the scoreboard was actually a hollow, low-volume rotation,
Institutions aggressively faded the closing print because of that geopolitical gap risk.
which instantly materialized as after-hours military strikes in the Middle East. Tech volatility, the VXN, is secretly flashing a 23-year high compared to the VIX, proving that options desks are bracing for impact.
And mathematically, the S&P 500 is trapped in a tight, dealer-controlled positive gamma range, heavily capped at 7,550.
And while all the institutional focus was on semiconductor deals and options walls today, tomorrow morning, before the opening bell, the macro focus violently shifts back to the health of the consumer.
Right. Delta Airlines reports their Q2 earnings tomorrow.
And given the exact spending destruction we just witnessed with PepsiCo at the convenience store, Delta is the ultimate litmus test for premium travel resilience.
If the consumer is pulling back on road trips, Delta's numbers will show the exact magnitude of that fatigue hitting the skies.
Which leaves you with a final structural disconnect to ponder as you build your trading plan for tomorrow's open. Look at the 2 entirely different economies operating on the tape right now. You have the everyday consumer pulling back so hard on $5 bags of chips and sodas that it fundamentally tanks PepsiCo's top-tier stock.
But on the exact opposite side of the market,
You have Apple casually signing $30 billion custom chip deals, and Meta spending billions on AI infrastructure like money is no object. So the question is, how long until that real-world cash crunch at the gas pump travels all the way up the economic food chain? Can a massive multi-billion-dollar AI supercycle truly survive in a vacuum if the end consumer, the person who actually buys the $1,200 iPhones and clicks the Instagram ads, is completely tapped out? Keep your eyes on the data tomorrow. We'll see you after the bell.